All right, let's look at Plug Power, ticker PLU. Right now, the stock is trading at $2.88 a share, and it's in the red for the session, down about 0.04 cents or 1.37% today. Now, for a stock this volatile, a 1.4% move is just normal breathing. But what's fascinating, and what most of the headline chasers are missing, is the profound disconnect between the company's daily operational announcements and its precarious financial reality. Just yesterday, we got news of another strategic partnership, this time with Edgewood Renewables, to build a renewable fuels facility in Nevada and an expansion with Floor Decor. This is the kind of news that should send a stock flying. Yet here we are, barely holding on to the $2.88 level. This isn't just market noise, it's the market actively trying to figure out if Plug is a visionary or a casualty. The tension here is palpable. You have an expectation, fueled by a constant stream of press releases and a massive $1.66 billion federal loan guarantee, that this company is the chosen one for the new hydrogen economy. The narrative is that this is the next Tesla stock, a ground floor opportunity. But the reality, when you look at the balance sheet, is a company in a desperate race against a ticking clock, where its cash burn is so high that these new deals, while promising, might not matter if they can't survive the next few quarters. Let's establish the common ground, the story everyone on SoFi and Robinhood believes. They see Plug Power as the leader. They see the deals with Amazon, Walmart for their forklifts. They see the $1.66 billion conditional loan guarantee from the Department of Energy, which was finalized earlier this year, as a government seal of approval. They see the new green hydrogen plants in Georgia and Louisiana coming online, promising to finally solve the cost of hydrogen problem that has plagued the company. The expectation is that Plug is building a vertically integrated hydrogen ecosystem, from producing the fuel to building the engines that use it, and that they are on the verge of turning the corner to profitability. They look at the stock's wild ride from under 70 cents to over $4.50 within the last year as opportunity. This is the story of a company about to scale, and the current sub-$3 price is just a temporary dip before the real ramp-up. But that story is dangerously incomplete. The reality is that this $2.88 price tag isn't a gift. It's a reflection of profound existential risk. The immediate challenge isn't about their 2030 vision, it's about their 2025 survival. The recent volatility we've seen, especially the sharp pullback from over $4 just a few weeks ago, wasn't just profit-taking. It was triggered by two seismic events that the bull case conveniently ignores. First, the company's management team just imploded. Andy Marsh, the CEO for nearly 2 decades, is stepping down, set to be replaced in 2026. And the company's president, Sanjay Shrestha, is also leaving. This is not a stable transition. It's a sudden high-level clearing of the deck right when the company is supposed to be executing its most complex scale-up in history. It completely undermines the confident projections of achieving positive gross margins by the end of this year. Second, and far more critical, was the recent capital raise. Just a couple of weeks ago, in early October, Plug announced a warrant inducement agreement to raise about $370 million. Now, raising capital isn't new for them, but the terms were a punch in the gut to existing shareholders. They were forced to sell 185 million shares at a price of just $2. This wasn't an opportunistic raise, it was a move of pure necessity. When you look at their last quarterly report from August, the numbers were terrifying. They ended Q2 with only $140 million in unrestricted cash. Their free cash flow over a trailing 12-month period was a negative $1.026 billion. They burned through $230 million in that quarter alone. You don't need to be a Fidelity Wealth Management advisor to do that math. $140 million in the bank with a $230 million quarterly burn rate means the lights go out. That $370 million raise wasn't for growth. It was for survival. It bought them maybe 2 more quarters. This is the central conflict that defines Plug Power today. The expectation is DOE loan and massive growth, but the reality is dilution and a short cash runway. Many retail traders, perhaps doing their first online investment on the Robinhood app, see this as a simple buy the dip scenario. They don't differentiate between a company like Apple stock, which gushes free cash flow, and a company like Plug, which incinerates it. This stock isn't being held in quiet, long-term Schwab Intelligent portfolios. It's a high-velocity trading vehicle. The volume on this name is consistently massive, often exceeding 70 or 100 million shares in a single day. This is a war between institutions shorting the stock based on its dire financials and a massive retail army representing nearly 50% of the ownership buying the hydrogen dream. This is why the stock can jump 20% on a new partnership announcement and then crash 15% on no news. It's unmoored from traditional valuation. Speaking of valuation, the metrics are schizophrenic. A discounted cash flow model, if you believe their out-year projections, could suggest the stock is worth over 7. But its current price-to-sales ratio is nearly 7x, while the industry average is closer to 2.4x. It is simultaneously and paradoxically overvalued on current performance and undervalued on its future potential. So what does this company actually do? For years, its bread and butter has been the Gen Drive fuel cell system, primarily for material handling equipment, forklifts. This is what clients like Amazon, Walmart, and now Floor Decor use. It's a good business on paper. Forklifts can be refueled with hydrogen in minutes, whereas batteries take hours to charge. The problem is, Plug has historically lost money on this business. Their gross margins have been negative. They've been selling their core product at a loss just to get a foothold, hoping to make it up on service and hydrogen fuel sales. This leads to the second, more ambitious part of the business, the ecosystem. Plug is trying to become its own fuel supplier. This is why they are building hydrogen plants in Georgia, Louisiana, and Texas, and expanding in Europe. The $1.66 billion DOE loan guarantee is specifically for financing the construction of up to 6 of these production facilities. The bull case reality is that once these plants are fully operational, Plug's cost to produce hydrogen will plummet, finally making their entire closed-loop system profitable. The bear case reality is that building these plants is front-loading an astronomical amount of capital expenditure, accelerating their cash burn before a single dollar of profit is realized. This is where the recent news becomes so critical. The announcements this week are important. The H2 Cast project in Germany, which they just successfully completed deliveries for and signed a new contract, proves their European logistics are working. The partnership with Edgewood Renewables to supply engineering and equipment for a sustainable aviation fuel plant is a fantastic sign of diversification. It opens up a new complementary market. But these are seeds being planted in a field that is on fire. The company is executing on its long-term plan while its short-term finances are in critical condition. The market sees this. It sees the good news from Edgewood and the bad news from the management shakeup and the $2 a share dilution, and it can't price the stock. The result is this 2.88 limbo, where the stock is just churning, waiting for the next catalyst to either confirm its survival or its failure. What about the institutions? Fidelity brokerage accounts and other major funds are divided. Filings show that while some, like Vanguard, have modestly increased their positions, others, like BlackRock, have trimmed. There is no clear consensus. Analyst ratings are a perfect mirror of this confusion. The consensus rating is a hold. You have firms like H.C. Weinstein maintaining a buy, while Morgan Stanley is underweight, and clear Clear Street just downgraded the stock to hold from buy, likely citing the execution risk from the leadership changes. The price targets are all over the map, from as low as 0.76 to as high as 7.35. This isn't analysis, it's a bet. When you open your Fidelity mobile app or SoFi investing platform and look at Plug, you are not making a traditional investment. You are taking a position on a binary outcome. So, let's talk about the future outlook, framed by this expectation versus reality. The bull case, the expectation, is that the worst is over. The $370 million raise, combined with their existing cash, gives them a runway of at least 2, maybe 3 quarters. They believe the new management, led by incoming CEO Jose Luis Crespo, will successfully steer the ship. They believe the Q4 2025 target for gross margin break-even is achievable, as the new, cheaper hydrogen from their own plants finally starts flowing. In this scenario, the DOE loan starts getting drawn down, the new projects are funded, and the company successfully transitions from a cash-burning R&D style company to a real industrial gas producer. If that happens,